You are listening to The Investor Way with Sam Ball and Jonathan McEwen. If you enjoy the show, please subscribe and follow us on Twitter at TIWTweets.
Hello and welcome to The Investor Way with myself, John McEwen, and my co-host Sam Ball. This week on The Investor Way, we have Coca-Cola HBC, BAE Systems, Hargreaves Lansdown, Nestle, InterContinental Hotels Group, and our US company of the week is Nvidia. Sam, do you want to kick us off with Coca-Cola HBC?
Yes, so Coca-Cola HBC, which is Coca-Cola Hellenic Bottling Company, and they have the bottling and distribution rights for Coca-Cola in the following countries: Armenia, Austria, Belarus, Bosnia and Herzegovina, Bulgaria, Croatia, Cyprus, Czech Republic, Egypt, Estonia, Greece, Hungary, Ireland, Italy, Latvia, Lithuania, Moldova, Montenegro, Nigeria, North Macedonia, Northern Ireland, Poland, Romania, Russia, Serbia, Slovakia, Slovenia, Switzerland, and Ukraine. So they are actually a Greek company, but they've been listed in London for about 20 years now. So they have come out with their full year results, and they've announced organic volume growth of 1.7%, led by their strategic priority categories, with sparkling up 2.5%, energy up 27.3%, and coffee up 31.5%. They've said they've had a strong finish to the year with 6.8% organic volume growth in Q4 and improving trends in all three reporting segments. Organic revenue per case growth was 15%, reflecting the benefits of revenue growth management incentives throughout the year. Reported revenue was up 10.7%, with strong organic growth partly offset by FX translation headwinds in emerging markets. Continued value per share gains in 2023 in both non-alcoholic ready-to-drink and sparkling of 110 and 80 basis points respectively. Comparable gross profit margin is up 80 basis points, reflecting easing cost pressures in the second half of the year. Disciplined investment in growth capabilities and good operating leverage have reduced comparable operating expenses as a percentage of revenue by 10 basis points, and the return on invested capital is up 230 basis points to 16.4%. Per region, organic revenue in the established markets was up 12.3%, led by pricing and mix, with organic earnings before interest and tax up 23%. In the developing markets, organic revenue was up 18.2%, with strong revenue per case expansion. Organic EBIT grew 26.9%. And in the emerging markets, organic revenue was up 19.9%, with volume growth as well as revenue per case improvement. Organic EBIT grew by 11.7%. We've said comparable earnings per share grew 21.8% to €2.08, supported by strong delivery and effective management of finance costs. Free cash flow increased by 10.3% to a record €711.8 million. And all these figures are in euros. Net debt of 1.6 billion and 1.1x net debt to comparable adjusted EBITDA, reflecting the strength of the balance sheet. Launched a 2-year share buyback program of up to 400 million in November, reflecting their long-term confidence in business performance. And the board has proposed an ordinary dividend of 93 cents a share, up 19.2% and representing a 45% payout. They've highlighted capital expenditure of 674.9 million was up 14.5% and is focused on sustainable growth. They acquired the Finlandia vodka business from Brown-Forman for 180 million net consideration in the year. They've launched Jack Daniel's and Coca-Cola in Poland, Ireland, and Hungary. And if we just go through the figures, some of which we've mentioned earlier, but volume was at 4.6% and the organic change was 1.7%. So I think the non-organic, I think they acquired the Egypt business. That might be the first full year of that. The net sales revenue was up 10.7% on reported currency to 10.8 billion and 16.9% organic. And net sales revenue per unit case was up 15% organic to 3.59 euros a case and 5.9% reported. The EBIT margins up from 7.7 to 9.4%. Net profits up 53.2% to 636.5 million. Basic earnings per share is up 52.6% to 1.73 euros a share, and free cash flow is up 10.3% to 711.8 million. Guidance for 2024 includes organic revenue growth at 6 to 7%. On a comparable basis, cost of goods sold per unit case should increase low to mid-single digits through the combined effect of inflation, transactional and translational effects, and organic EBIT is expected to grow by 3 to 9%. In terms of the valuation, the business trades at a PE of 16.65 and has a historic dividend yield of 2.7%, but as mentioned, it is going up by 20%. I think these are an excellent set of results. I think it's taken a bit of a beating in the last couple of years with the Russia and Ukraine situation, and also the cost of living, because their biggest cost is the bottling. It's performed really, really well. So when Russia invaded Ukraine, it dropped to about £15 a share. It's now back up to where it was before that, about £24, £25 a share. So at the minute it's £24.60. I think that's justified on these results. It's kind of shrugged off Russia and Ukraine, not that they were massive, massive markets for it, but you can't even tell they're missing now. And I just think it's a really, really strong performance. It operates in some really, really interesting markets, especially all the developing markets. And it is a good, I think, we talked about it before, but I think it's a very good emerging markets play, but with that very strong Coca-Cola brand. So I think it's a lower risk emerging markets play. But I think these results are excellent. John, what about you?
Yeah, no, I would agree. I thought the results were really good. And I know we covered it shortly after Russia invaded Ukraine, and I'll have to listen back to the episode. But I think a bit uncertain, and bloody hell, this is the risk that you're taking by investing in a company like that. But I think actually, when you look at the overall markets that it covers, and that Russia and Ukraine didn't account for a huge amount of the sales, it looks really strong. And as you say, it's potentially a more interesting growth story within Coca-Cola, which whilst a fantastic company over in the States with Daddy Coke, is much more sort of, I suppose, saturated, whereas this is that sort of growth play on it. So yeah, I like it a lot, and it's not, I don't think, particularly expensive.
What do you think of the valuation? Because I think last week we did look at Daddy Coke, which I think it was down to a PE of about 21 now. You can get this for 16.5. No, I think it definitely should be cheaper than Daddy Coke because it doesn't have the margins, because it is having to pay the fees to Daddy Coke. But even still, I think for the figures it's putting up, the markets it's operates, and it's also got quite a decent dividend. I don't think 16.5 is outrageous for it. I think it's pretty fair.
Yeah, no, I would agree with that too. Yeah, I think 16.5.
How would you compare it to, say, AG Bar or Britvic?
Good question. If I were to choose between them, I probably would go for Coca-Cola HBC actually, and I think I'd be doing it more on potentially the growth opportunities and the markets it operates in. I appreciate with Britvic you do have the Brazil venture, but I think overall I'd probably go with Coca-Cola HBC. I think it's also interesting within the results that the coffee segment. So I guess that's, well, in fact, I'm sure that's related to Coke's acquisition of Costa, and then also the energy drinks growth, and then now JD and Coke added to it. So I think there's a lot to like about it.
I would agree. Should we move on to BAE Systems?
Yeah, so BAE Systems. So we've covered it a couple of times on the show before. BAE, it's the UK's largest defence company, manufactures fighter jets, aircrafts, submarines, cyber defence systems, and everything of that nature. Biggest market by far is the US, and the group had their full year results out last week, with BAE Systems full year sales growing to £25.3 billion, up 9% when ignoring the impacts of currency, and it's ahead of the group's prior guidance. All segments delivered growth, with maritime seeing the biggest uplift as funding for the Dreadnought submarine programme was accelerated. Underlying operating profit rose 9% to £2.7 billion, in line with sales growth, as margins remained broadly flat, and free cash flow improved from £2 billion to £2.6 billion, and net debt, excluding lease liabilities, roughly halved to £1 billion. Since the year end, the £4.4 billion acquisition of Ball Aerospace has been completed. In 2024, BAE sales and underlying operating profits are expected to grow between 10 and 12% and between 11 and 13% respectively. And this includes a nearly full year contribution from the acquisition. A final dividend of 18.5 pence per share has been announced, and that takes the full year total to 30 pence, and that's up 11.1% on the prior year. And the shares were broadly flat on the results. In terms of valuation, BAE has a market cap of £37 billion and trades at 18 times forward earnings, compared with a 10-year average of 12.5, and it has a prospective dividend yield of 2.6%. I thought these results were very good, and the group now has an order book of £69.8 billion, with 37.7 being added in 2023. I think it's a business that's looking a lot healthier now, and I suppose the political instability and global tensions is part of that reason. But it had been very indebted only a few years ago, and balance sheet much stronger now, even after the £4.4 billion acquisition of the US-based Ball Aerospace. Lots of these projects happen over a number of years, so the outlook for the group, I think, is also very strong. Of course, that is reflected in its valuation. At 18 times forward earnings, for a company like this, it is on the pricier side, but I think looking at what most people would expect when it comes to sort of, I suppose, the geopolitics, it probably does suggest there are going to be continued strong sales for the group, and that revenues, I guess, expected to continue to rise on that basis, probably over the next 5 years. Probably not one for me, but I think it's interesting to see how the group's fortunes have turned around since we started covering the show, but particularly over the last 5 years. Sam, what are your thoughts on these results and BAE Systems?
Very good set of results, but I find the business probably too difficult to understand. It's, for me, very much like a pharmaceutical or something like that. Even still, I think for the figures we're used to, I appreciate it has turned around a lot in the last couple of years, but for the figures that we're used to seeing from it, and the fact that I think it is quite a cyclical business, to buy it near what could be the high of the cycle at 18 times earnings, I just don't know why you'd pay that. I just think it's too, even if I could understand it, maybe I'd see something that I'm missing now, but it just seems very expensive for what it is.
Does that, I suppose, the outlook, and this isn't something I would certainly like to speculate on, but with the global instability, if that were expected to continue and countries were going to invest more of their GDP in defence, that is something that's sort of underpinning this valuation.
But that's really hard to predict as well, because you don't need the macro. You just need like a couple of peace treaties. A couple of elections don't go the way you think they're going to go, and all of a sudden you're in quite a stable. Go back 2 years. I don't think we expected this much instability now. In 2 years' time, it could be completely different again. So I wouldn't try and predict it.
Fine. So not one for you and not one for me.
Not for me at all.
Okay, fine. Okay, on to one that you're less keen on now than you have been a couple of years ago. Hargreaves Lansdown.
Also a stock that I own, unfortunately. But Hargreaves have come out with interim results for the 6 months ended 31 December 2023. They've announced net new business of 1 billion, which was down 38% compared to the 6 months ended December 2022. Total assets under administration was up 12% to 142.2 billion, but I think that's mainly been helped by rising share prices. Revenue was up 5% to 368.2 million. Profit before tax was down 8% to 182.5 million. Underlying profit before tax was up 5% to 221.5 million. Diluted earnings per share was down 14% to 28.5 million. Underlying diluted earnings per share was down 3% to 34.6 million, and the dividend was up 4% to 13.2p a share. It's now 6 months since the new CEO took in, and he said that it's clear that the business is built on a strong foundations, a proud heritage with a trusted brand and knowledgeable client-focused colleagues. These results I thought were pretty lacking in information, annoyingly. I don't know if because they don't have much to boast about, but anyway, in the CEO's statement, there were a few more interesting bits. So I'm just going to take a few random extracts of it, so it might not flow as he intended. But he said, our gross inflows to the platform were up year on year. However, our outflows were up too, meaning that overall our net new business came in at 1 billion compared to 1.6 billion last year. Outflows were highest in the products that our clients use more for transient savings and investing, such as our fund and share account, driven by cash withdrawals to deal with the cost of living issues and or to pay down debts. The period also saw an increase in transfers to banks and building societies to take advantage of cash ISA products. We responded to this by launching a cash ISA last year and the first multi-bank cash ISA in January 2024, helping clients spread their allowance across multiple banks and across easy access, limited access, and fixed-term cash ISA products. Our pension products continue to see the lowest level of outflows, with inflows ahead of last year. We retained 41% of interest during the period and expect this to be about 36% in Q3 2024, and we do not charge platform fees on cash. Our research shows that currently only 13% of UK households are on track for a comfortable retirement, and 1/3 of people, 34%, have less than £1,000 in savings. We are operating in a large and growing market, estimated to be 3.7 trillion by 2026. And they are focusing on 3 areas now. Number 1, to continue to deliver strong inflows by building investment confidence through targeted content and making it easy through frictionless flows to drive new client acquisition and assets under administration growth. 2, enhancing the client experience by resetting our client service levels and enhancing the digital experience to make it easy to execute with Hargreaves Lansdown, driving client retention. 3, evolving our product mix by expanding our proposition and digital features to drive client retention and acquisition and ultimately assets under administration growth, especially in active savings and pensions. In terms of the valuation, the business trades at a PE of about 11 and has a yield of 5.62%. My view is I think these are quite disappointing results. Not massively surprising, though. I think they're pretty similar to, I think, what we saw from NatWest, which I think sort of is quite significant of what the business has become over the last few years, and that it's just a cyclical business that seems to rise and fall on the back of interest rate changes. I know it's the biggest player in this market, but it doesn't seem to have any kind of competitive advantage when you look at these figures. And certainly, I mean, we've covered this stock for like 3 years now. I wouldn't say we've noticed any competitive advantage, and any advantage it did have, if anything, has probably been eroded in the time we've covered it. That being said, it has continued to get cheaper and cheaper, and it now seems to have stabilized at about a P of 11. Don't think that's unreasonable. The main concern is that as the interest rates are going up, you do start to see larger outflows to the point where it starts to have a knock on assets under administration. I think it's all right at the minute because this sounds like they're getting the larger outflows, but it's being offset by the increase in the stock market. But I know they've launched the cash ISA, but it doesn't seem to have made a huge difference. If people can go and just get 5% in the bank, there is just less incentive to invest, which isn't good for Hargreaves. It's a bit of an uncertain medium-term future, I think, as well. That being said, if they can continue doing what they're doing, I don't know if they really need to grow that much at a P of 11 and a yield of over 5%. It is pretty cheap. I think that's the main reason I'm holding now, just because it's gotten so cheap that it's not a terrible, it's got a decent yield now. So it's not a terrible business. I definitely wouldn't buy at these levels, but I don't really see any point selling when it is just so cheap. John, what are your thoughts?
Yeah, similar. I thought results a bit disappointing, but probably what we've been coming to expect from Hargreaves now. I've said for a long time I didn't like the industry, I suppose, and I think it is very commoditized. We have seen AJ Bell and Hargreaves slashing their fees, which obviously as consumers is great, but not good for the businesses. And then I think the other thing that I've noticed more, and I've actually recently changed platforms, but there are lots of switching bonuses, switching from one platform to another. Sometimes they can be as much as a couple of £1,000s. And switching, a bit like switching between your banks, is actually incredibly easy, and often it can take a week and it's pretty seamless. So I don't think that is good, and that race to the bottom. And I think Hargreaves, probably as a platform, did have a bit of an advantage in the past in the brand and things. But you watch any sort of terrestrial TV now, and in terms of the adverts, there's a lot. Interactive Investor is popping up, and there's a lot of sort of switch. AJ Bell, another one, a lot of switching, I think, going on, which again, as what still is the market leader, is a bit concerning. But I guess that's all reflected in that valuation, and it's even if it doesn't grow, if it just held its own or around that, the sort of what it's doing at the moment, that would still probably be okay. But it's not one that I'd be, going in to buy.
Well, they are still growing. The growth numbers aren't awful, but they're not. They've stopped talking about market share in the results now, so that must be going down. Especially when you see the growth figures when we do cover AJ Bell, they've got to be taking the market share from someone. So I think their growth figures are flattered by the fact that they're in a growing market.
Yeah, no, that's right. And I suppose, as they have said when they've looked at the UK population and an aging population, planning for the future, retirement, what will happen with the state pension. These are all things that, if there is a drive, a bit like when Labour introduced the ISA in the first place, if there's anything, more of a push towards that, then Hargreaves, along with the others, would be beneficiaries. But I guess, like you say, though, it's if your bank is paying you 5%, and if you're not at the point where that would be, paying more than £1,000, and you wouldn't be paying, or a lot of people wouldn't be paying tax on that. I guess it's just, why would I go and set up with Hargreaves or some of the other players? And the bank apps are generally quite good. So if they are promoting through those, and you can just sort of open it up and transfer a bit of money within your regular bank, then again it disincentivizes sort of setting up with Hargreaves or another player.
But yeah, it's like with mine, like a lot of my spare money every month does go into the Hargreaves account.
Yeah,
it is less so now. So like, for example, like it's tiny, but like with NatWest, they do that thing where you can save 150 quid a month, they'll give you 5% interest. Which is, so I've set that up. I know it's only 150 quid, but it's probably 150 quid that would have been going to Hargreaves otherwise, because I wouldn't really have had anywhere else to put it. Like the Chase Saver, that's giving 4.1%, and it's like, you do have to think of it. You've got more of a decision on your hands. Anyway.
When we first started covering it, and Hargreaves, you had interest rates below 1%, and I guess everybody was thinking, I'm getting no interest. What can I do to make my money work? And you were then going to Hargreaves, AJ Bell, all of those companies, whereas now you just think it's not the immediate thought for a lot of people. And I suppose cost of living crisis is another issue that reduces the ability to go for a lot of people to go and do that.
Should we move on to one of our favourite consumer goods companies?
Yes. So Nestle, owner of Nespresso, Kit Kat, many other brands. And historically, since we've started over the last few years, it's generally been putting up the best numbers from all of the consumer goods companies. Anyway, last week they had the full year results out, with Nestle's full year sales reaching 93 billion Swiss francs, which reflects organic growth of 7.2%, as price hikes of 7.5% offset a small decline in volumes, and both developed and emerging markets were delivering organic growth. Underlying operating profit fell by 0.3% to 16.1 billion Swiss francs due to negative foreign currency effects. And ignoring the effect of exchange rates, underlying operating margins increased by 40 basis points to 17.3%. Net debt stood at 49.6 billion Swiss francs as of the 31st of December 2023, compared with 48.2 billion a year earlier. Free cash flow was 10.4 billion Swiss francs, and that was an increase of 3.8 billion, mainly due to a reduction in inventory levels. For the new financial year, organic sales are expected to grow by around 4%, and underlying operating profit margins are expected to show a moderate increase. The final dividend of 3 francs was announced per share, and that's a 5-cent increase. And the shares were down nearly 5% in early trading. In terms of valuation, Nestle has a market cap of 251 billion Swiss francs and trades at 19.4 times forward earnings, with a yield of 3.3%, and guidance for organic growth of 4% is guided for 2024. I don't think these results were bad, but by Nestle standards, perhaps slightly disappointing. I think seeing, volumes drop off that little bit. I guess it's just how well this company has done over the last few years, and the numbers that it's been able to put out in comparison with its peers, because it can't go on forever with the price hikes and not impacting on volumes. I think it was remarkable when Nestle had previously been able to stick up the prices by similar amounts and actually see volumes grow. That was I suppose, a testament to the brands that they own. In terms of its valuation, I still think it's very expensive, but I'd probably still argue it is the best in the business at what it does. I mean, certainly if you compared these results with Kraft Heinz, these ones are much better. I guess the question would be, if you were looking for a consumer goods company, would you now, with, say, hoped turnarounds in companies like Unilever and their cheaper valuation, be getting better value and better growth, say, over the next 10 years? I suppose that is the big question. I probably myself wouldn't be rushing to buy shares, even though they have fallen a bit. But I think it's a quality company nonetheless.
I agree. I also thought these results were quite disappointing. I think it's just a volume drop off, really. I know we've seen similar from a lot of the competitors we've done in the last few weeks. So, we've done Kraft Heinz, we've done Unilever, we've done PZ Cousins, and it's all, I mean, PZ Cousins was a disaster for very separate reasons. But yeah, it's just we have gotten used to seeing volume increases from Nestle, even on the back of price hikes. So that's quite disappointing. And it's slightly different, but we covered Coca-Cola last week, and they hiked prices by 11 or 12% and volume was up 3% or something like that.
Yeah.
And, it's still possible. I don't know if it's just because they've already pulled that, like you say, they've already pulled that lever and there's only so much you can hike prices, even with the brand quality, before people are just, before people it does start to have an impact. But I think the problem is it is priced at 19 times forward earnings, as if this is just a bit of a wobble. And you kind of expect it to get back to 9-10% with volume increases. Even then, I think it's still fairly pricey. But if it doesn't do that, I think it could have but it's still, I think, quite overpriced compared to some of its peers. I appreciate you paying slightly more for the brands, but, the yield's not amazing on it. You can get a high yield from Unilever. I think the market, although it has dropped a bit, it's down from like a P of like 25 down to 19. I think if it doesn't turn these results around, I think we will see it cheaper still because it is still priced above its peers. So I think people are thinking this is just going to be a temporary blip, but really great business, but still just too expensive for me.
Okay. On to InterContinental Hotels Group then. I don't think we've covered this for a while.
No, we haven't. So it's one of our favourite hoteliers, although Whitbread has given it a run for its money with the last set of results they put up. But they have come out with their full year results to 31 December 2023. And revenue was up 17% to $2.164 billion. And all these figures are in dollars, even though it's UK listed. Revenue from fee business was up 17% to $1.672 billion. Operating profit was up 23% to $1.019 billion. Fee margin was up 3.4% to 59.3%. That's a very impressive margin, that, isn't it? You don't see that from Whitbread, as well as they are doing.
No.
And adjusted EPS was up 33% to 375 cents a share. And for the group as a whole, the total revenue was up 19% to 4.624 billion. And dividend up per share was up 10% to 152 cents a share. And the net debt was up 23% to 2.272 billion. Although on an operating profit of just over $1 billion, that's not really at a concerning level. They've highlighted strong trading with global revenue per available room up 16.1% year over year and 7.6% quarter over quarter for the final quarter, and up 10.9% versus 2019 for the year. If we split that by region, America's revenue per room for the year was up 7%. Europe, Middle East, is that possibly Australia and Africa? It's EMEA. It's normally EMEA. I think it's Europe, Middle East, Australia, and Africa, but that is just an educated guess. Was up 23.7%. Greater China's up 71.7%, reflecting the differing level of travel restrictions that were still in place in 2022. The average daily rate is up 5% versus 2022 and 13% versus 2019. They opened 49,900 rooms, which is 275 hotels, and that's up 16% year over year, excluding Iberostar. And the global estate pipeline is 946,000 rooms, which is 6,363 hotels. They've signed 79,200 rooms, which is 556 hotels, which is up 26% year over year. And the global pipeline is 297,000 rooms, which is 2,016 hotels, which is up 5.5% year over year. Fee margin was 59.3%, which is up 3.4%, driven by trading recovery in Europe, Middle East, Australia and Africa, and Greater China. Could be Asia and Africa, actually, if they separate Greater China. Anyway, net cash from operating activities was 893 million, and that's up from 646, with adjusted free cash flow of 819 million, up from 565. The latter representing a 129% conversion rate of adjusted earnings, up from 111% in 2022. Net debt increase of 421 million reflects a strong adjusted free cash flow. There have been 1 billion of shareholder returns and an adverse impact from foreign exchange of 105 million. They completed 2023 750 million share buyback program and paid 245 million in dividends. And they've announced a new 800 million buyback program, which together with ordinary dividends is expected to return over 1 billion to shareholders in 2024. And that's on a market cap of, that is in dollars, but it's on a market cap of 13.77 billion pounds. That's a pretty decent return, actually. And they've said global system of 946,000 rooms, which is 6,363 hotels at 31 December, weighted 66% across mid-scale segments and 34% across upscale and luxury. And more than 40% of the global pipeline is under construction, broadly in line with prior years. Year over year, in terms of systems, Americas is up 0.8%, Europe, Middle East, Asia or Australia and Africa, we're not sure which, is up 7.7%. Greater China is up 7.7%. And total pipeline for the group as a whole, 296,000. And of that, 109,000 is the Americas, 82,000 is Europe, Middle East and Africa, and 105,000 is Greater China. In terms of the valuation, the business trades at a PE of 28 and has a yield of 1.45%. I think this is a very expensive business, but it is a business of really high quality.
So I think if you look,
it's about 3x, isn't it?
It is. So I think even if you bought at the peak in July 2019, you'd have got to a low in 2020 of about £28 a share, and that would represent about a 50% fall. But even if you bought at the peak then in 2019, it's the share price has done about 50% since.
I mean, the share price has just been phenomenal. It's still only trading at 28 times earnings, which I don't think is outrageous given the kind of results it's putting up. The pipeline looks good. The margins are insane, and you are going to pay a premium for that. Really solid set of results. I think you can make an argument for 28 times earnings. I don't know if I would pay it. I think because it's in hotels, I think we were probably quite dismissive of it. But in terms of the type of business with the high margins, the low costs, I didn't expect it to do what it's gone and done. But that being said, the industry's doing quite well. Whitbread's had a cracking set of results, and I think it's easy to sit there and look at the graph and be like, well, look how well it's done. But 3 years ago, it didn't seem like that, and it was not clear whether a lot of the hotel traffic was coming back, or whether it was all going to shift over to Airbnb, or whether there would be, less business travel, what impact that would have. So I think, fair enough to anyone that has actually bought it and backed it, but it was not obvious. Like 3 years ago, it was just not, it looked like it was in quite a poor state, actually. That being said, I don't think I quite appreciated how good the margins were going to be and how much it would recover. But you could make the same argument for Whitbread.
Yeah.
But really, really impressive set of results. I still don't think it's a business that interests me. Not at the current price, and at the previous prices, I had quite a few concerns when it was cheaper. But interesting business, high margin. I do like it as a business, but I'm not sure I'd ever own it. What about you, John?
Similar, and I would point out that it's a company that I don't know if it's Nick Train and Terry Smith both have it, and it was one of those ones in there. I just thought, that's an interesting choice, but never really fully got it. And I think seeing this now, I think I get it a lot more. It's probably still not one for me, but I can appreciate the quality and how this business is structured and how it runs, and those really impressive margins. So yeah, but again, it's very difficult with hindsight, and when you're actually in it at the time, the market was backing Zoom and equivalents heavily. These were the most unpopular things around.
And also, when it had lower earnings, that debt would have looked a lot less attractive.
Well,
Because
absolutely.
it would have been, as a proportion of the earnings, much, much higher. So I can see why we didn't really rate it that highly at the time. I think maybe if we'd followed it pre-COVID and we'd had a better appreciation for the business back then, maybe that would have made a difference. But
yeah.
Should we move on to another quality business
that is very, very popular at the moment? So it's Nvidia. It's the graphics card company that has become a dominant player in supplying artificial intelligence hardware and software. It had its full year results out last week, and there were standout performances from the data center division, which is now over 80% of sales, and also gaming. Operating costs increased at a much slower rate, $3.2 billion, helping operating profit to $13.6 billion, to rise over 10 times higher than the comparative quarter in the previous year. This drove free cash flow from $1.7 billion to $11.2 billion, and net cash stood at $16.3 billion. First quarter revenues are expected to be close to $24 billion, ahead of market forecasts of $21.9 billion. Spending on share buybacks in the quarter came to $9.5 billion. A quarterly dividend of 4 cents a share will be paid in March, and the shares were up 9% in after-hours trading. In terms of valuation, Nvidia had a market cap of over $2 trillion and trades at 30 times forward earnings. I thought these results were fantastic, with the growth being turbocharged by the AI boom, with Nvidia's chips training models like ChatGPT. And I think that's one of the things that's so attractive about Nvidia, is that it's providing the underpinnings to the technology that Amazon, Google, Meta, Microsoft are all using. And as we know, it's a massive growth trend. So I think incredibly high quality company, and it's had outstanding growth. I guess the difficulty with all of these types of companies, and quite a lot of the Magnificent Seven, but particularly Nvidia, is it's got a market cap of over 2 trillion now, and it's trading at an eye-watering 30 times forward earnings. It's really difficult to get your head around. I know in my own portfolio, I don't own Nvidia directly, but I do have sort of global trackers. And of course, Nvidia and some of the other Magnificent Seven are making up a disproportionate amount of that. I don't know whether I could ever buy this company directly. It's one of the ones that I sort of loosely said to you, Sam, we should pick for our fantasy portfolio back in 2020. However, we've joked about that, and had it been my own money, and certainly with my own money in 2020, I wasn't backing Nvidia. I wouldn't have even then paid up for it. But it's crazy to see what it's done since then, and I guess we hope it continues to do.
Yeah, I do remember the discussion. I think it was like 70 times earnings or something at the time. I was just like, John, we're not paying that.
Just a bit of fun, Sam.
I'm not going to look at what the share price has done. But the thing is, if we'd put it in there, it would have been sold after a year or two.
Absolutely, it would have been.
There's no way we'd have done the last review and not sold it.
I couldn't have done a flosser on it, that's for sure.
No, we couldn't.
I wonder whether Flosser has got it in his portfolio, but anyway.
Seems like the kind of thing he would have.
Yeah. Or his children might have picked it.
Probably, yeah. But it's just, I think, fantastic business. I mean, you can't knock results. Operating profit up over 1,000%. It's just the results. Insane. We'll just forget about them, because they are basically perfect. I think they're beyond perfect. It's beyond what anyone could have reasonably expected for this business, although not based on the share price. But yeah, forward PE of 30. I just think we've seen this business before, and I think it's a cyclical business. I think it's a fantastic cyclical business, but to buy it near the top of the cycle at 30 times forward earnings, if it drops off for a year or two, which it will at some point, all of a sudden it's trading at 100 times earnings. It's just, I don't see where the returns come. And you see it with like the dividend, like they're a bit flush with cash, so now they're doing buybacks. They've done 9.5 billion, and the market cap's 2 trillion. They can't even return money to shareholders, despite how good these figures are. Like the quarterly dividend, 4 cents a share. Share price is $822. Like, where is the cash ever coming back to investors? It just can't at these levels. I think fantastic business, but I think people have gotten too carried away. And it basically, it needs to do not quite this much, because, a few 1,000% years and you soon grow into any valuation. But the figures it needs to continue growing at, I just don't think it's sustainable, given it's a cyclical business. I think if you are seriously interested in owning it, I think you're better waiting, because at some point you will get it at a low in the cycle. Because I really do think this is cyclical, and I think time will prove that. But fantastic business, and it can't help the valuation that it trades at. But I would just never pay that.
Out of interest, what do you think about the rest of the Magnificent Seven?
What's in it now? It's all the old Fang boys, and then who's the seventh?
So Nvidia is obviously there.
Facebook, Amazon. Is Netflix in there anymore?
No, Netflix is out.
So Google will be there.
Google is there. So
Microsoft. Who's missing? Apple? I've already said that. Apple and Amazon. I don't know. I suppose it doesn't matter, because they're all going to be those kinds of businesses, aren't they? But I think Nvidia looks like the odd one out there.
So the Magnificent Seven, you've got Apple, Alphabet, which is Google, Microsoft, Amazon, Meta, Tesla, and Nvidia.
I mean, I think Tesla and Nvidia sort of stick out a bit for me.
Okay.
I think the other ones are just such phenomenal businesses, and I don't think they're as cyclical. I think Tesla is. I think Tesla and Nvidia, really, they are just hype stocks that have been hyped up to a level that they're being putting up with. I mean, I think it's unfair on Nvidia. I think Nvidia is a high, but I just don't think Tesla's ever going to put up the figures to justify its valuation either. Nvidia, I think, possibly could, but it is a cyclical. So I just think, it's kind of like buying a house builder at the top of the cycle for 20 times earnings or something. You just don't do it. I could be proven wrong, look like an idiot in a year or two, but I've already done that with a fantasy portfolio. I'll double down. But I think, what would I feel comfortable owning, even at the current expensive share prices? I think, the Amazons and the Apples and the Googles, they don't need to do much just to justify the current valuation. Whereas, the Teslas have to basically dominate the world to justify the current value. I know which ones I'd rather have in my portfolio. It would, those two would be a very distant last. What about you? I'm assuming similar.
It would be similar. I feel more comfortable owning it as part of a global tracker. Basically, I would put it that way. And it has performed well. They have all been performing well recently. But I think owning some, but not all of those companies directly, would make me a little bit nervous. I think averaging in a sort of tracker, I can sleep at night a bit more easily.
So, of the 6 businesses we've covered today, Coca-Cola Hellenic Bottling Company, BAE Systems, Hargreaves Lansdown, Nestle, InterContinental Hotels Group, and Nvidia. Including valuation, which do you like the most and which do you like the least?
I would go for Coca-Cola would be my first choice, HBC. And last, it's a difficult one. I mean, taking into account valuation, I don't know, it's difficult to justify Nvidia, but overall I probably wouldn't like HL, although again, valuation does come into that, and you think it's a lot cheaper. So I don't know, difficult to say for the bottom. Probably say HL, but I'm really excluding Nvidia with that, because it feels like it's just a different kettle of fish altogether.
I think for me, so Coca-Cola Hellenic Bottling Company would be top. I think I probably would put Nvidia bottom, just because the valuation is, I think, so extreme that I would just never pay. I would, of all those 6 stocks, if you were to put them in my portfolio, I would be most concerned about Nvidia. It would have to go straight away. Whereas if you told me you have to hold BAE Systems for 3 years, I wouldn't be thrilled about it, but I wouldn't be sweating in my bed at night.
No, I mean, I could sleep with HL. It wouldn't be. It certainly wouldn't be me going out to buy it, but you could certainly sleep with it. I think sleeping with Nvidia, bloody hell.
But you could just wake up one night and it's gone.
I don't know about that, but you could wake up and, over a few months it could be cut in half. It's that kind of.
I think it could do a lot worse and get.
Well, it could be more than cut. Yeah,
could be like 80%.
Cut in half is. Could live with that.
Yeah, right. I think that's everything in that case.
Well, thank you again for listening, and we'll see you again next week.
See you next week.
Thank you for listening to The Investor Way. To get in touch, please follow us on Twitter @TIWTweets. This podcast is for entertainment purposes only and does not constitute financial advice. Neither Sam nor Jonathan are financial advisors. For investment advice, please consult professional advisors.